Hello viewers, this is Ernesto Fori and today we're going to talk about macroeconomics. We're going to talk about personal taxation I'll say, and we're going to start from week 2. When you say personal tax, let me erase this one quickly. This is what we're going to be doing today. Right, let me quickly take you through week 2 lecture slides. It says introduction to tax, and tax is normally split into, like, in every individual is entitled to pay tax, and your salary that you pay income tax on it, and some normally income tax are received on gross, some tax are received on net. Some tax are received on net, excuse me for that. And trading, like, income tax are received on net, like after you get your income. Normally what you see is like tax has already been deducted by your employer, and trading and property income are normally like received on gross. This one note, your PAYE is a system that ensures that your employer take a correct tax. See here, you can see here, say the system. This is a system that is operated by employers to enable that to deduct a correct amount of tax in the national insurance each week. So that's the PAYE. You have to bear in mind. We quickly jump on to the rate and allowance income tax. If you're in the UK, each country has its own tax system. If you're in the UK and you're working, and you're entitled to salary, your first 8,105 pounds is tax free. So if you get 8,050 pounds, that means you're not going to get tax at all. If you get 8,104 pounds, you're not going to get tax at all. Right, so now you get this figure, this 8,106 pounds, you start getting tax 20%. So the difference, the first 8,105 is free. So if you get 8,106 pounds, that £1 extra that you get will be what? Will be taxed. Do you understand? So that's what we have to know. This for the current year, that is for the previous year. So let's quickly jump on to the next question. The first question, which says the personal allowance reduces where the income is above 100,000. What this one is trying to imply is when you have an income of 100,000, or let's say 150 pounds, 150,000 pounds, when it gets 100,000, yeah, every £2 that we add on this 100,000, we deduct £1. Yeah, £1 of this figure, the personal allowance. Do you understand? So what the government or the tax authority are trying to do is, when it earns too much, then they try to take this personal allowance off the this personal allowance off, and you get too much tax. You get too much money. That's my own interpretation. So we have a first question here. It says, how much would you need to earn in order to lose the personal allowance altogether? How much you need to earn so I can lose all this amount? Right, this is how I approach it. The question said, if £1 is £2, yeah, then 8,000 8,105 is to what? That's a question you have to ask yourself. If 1 is to 2, then 8 is to what? That means to be more. If more, we have less divide. So we have 8,105 divided by 1 times £2. What we get here will be 16,210. 16,210. This will be our answer for this solution. So what we do, we add if every 100,000 over 100,000 that you earn, plus additional 16,210. If you get this figure, which is 116,210, as soon as you get this figure, and put it, as soon as anytime you get this figure, put in bold, and that way, as soon as anybody get up to this figure in life or his work, you're not entitled, you're no more entitled to the personal allowance of £8,105. You're no more entitled. So all this amount will be taxed. At first, what we do is we subtract 8,105 from this amount and we start taxing you. But now, since you got this figure, you will be taxed all this amount, right? So let's go to the next question. It says make a note of this figure. So we put a note. 16,210. This you have to bear in mind. This figure might come in exams and you might be tricked with that. Our next stage is income tax rate and taxable band. What this tells us is that we have a category or a band in which we tax people, whereby the tax applies if we earn from zero. If you have a savings account which is not income, which is an income, it's an income tax. Maybe the money that you get from your company or your employer, you put in the bank. That interest, or the savings, the interest on that savings, we calculate tax on it. If that interest in a year yield is from 0 to £2,710, you get taxed 10%. Then afterwards it changes. So if you had more than this figure, that's 2,710 or 11, then you go to 2,711 to this amount, then you start getting tax of 20%. So 20%, and it follows like that. So if it's more than that figure as well, you get taxed 40%, and if it's more than the difference is more than this one, you get 50%. You subtract, get the difference, and you charge 50%. So this is what we'll be looking today, the details. Right, let's start with a seminar task. The first one is assume a single person had following non-savings income. What the question says is non-saving income. That's what we think of that. Great. non-saving income.